Welcome back. You are with this special. We're calling it the Budget 2023 Fine Print, and we're with a panel of experts to decode what this budget means for the BFSI sector. We've discussed, of course, a lot of announcements, including insurance, including MLDs, InvITs, and what GIFT City has had in store. But let's go back to an issue which, of course, impacts a lot of people in the financial landscape, and that is the withholding tax on dollar loans, basically the interest that is to be paid on dollar loans. So for this, I'm going to come to you, Amit. Explain to us what changes, if anything at all. I think the rate of interest was at 5%. What happens now?
So the rate of interest under 194 LC and LD, which is for dollar loans and interest for the foreign portfolio investors respectively, now goes away from 30th of June 23 and is now at 20% under domestic law. So for the dollar loans, it should not be looked at as a tax rate for the foreign lenders, because typically all these contracts are on a gross up basis. So it's the Indian borrower who bears the cost. So considering that, if the cost goes up, even under the standard treaty, the minimum rate is 10 to 15%. Then the tax gross up cost is actually going to go up for the Indian borrowers. So it's actually the additional cost of borrowing for things such as capital outlay, because these are all term loans. So that's for the 194 LC. So far as LD is concerned, which is the interest rate for foreign portfolio investors, they usually assess the yield on a net of tax basis. So in a rising interest rate scenario, it's going to be the lower yield from the Indian securities as well as the corporate bonds. So my take would be that we still need more time to get through the new regime. So this needs to be extended for another 3 years till the global economic stress as well as the rising interest rate environment settles down. Otherwise, it's going to increase the cost for the Indian corporates.
So now that the provision has not been extended, at least there's no such announcement, what will the rates be, the prevailing rates?
So the domestic tax law rate goes up to 20% from 5%. Wherever the lenders have tax treaties, depending upon the treaties they have, the rate may be 10 or 15%. And then there'll be a lot of documentation, particularly for the dollar bonds, for example, issued by the Indian companies. So administrative compliance for the Indian companies and the lenders is also substantially going to go up.
Okay, sure. Amit, just one more point on TCS and TDS provisions. I think there was a big ask that the multiple rates that we have, tax collected at source or deducted at source, there should be some harmonization, some rationalization. With respect to the financial services industry, is there anything there?
Yeah, so we were expecting some rate rationalization because government has made it clear that they want TDS or TCS as their tracking mechanism, and there's no taking away from that. But what the industry wants is a harmonious, unambiguous, specific TDS regime where we know on what amount we have to deduct tax and maybe moderate 1 or 2 rates which could be applied. That will ease the compliance burden. That will also ease the ease of doing business. And that will ensure that the compliance is not left to anybody's interpretation. So what I ask from the government is that we need a simple regime and few rates. So no running away from compliance. We want to comply, but please simplify it for us from a ease of doing business perspective.
Gentlemen, we're coming down to final thoughts then. So let's take a sort of quick, last words from all the panelists. Tarun, let me come to you. We've, of course, discussed the insurance hit. That's the big negative. Anything else that stood out for you in the budget?
So there is only one positive on PMJJBY. The stamp duty is waived off. So that is something which will become this product more sellable from the insurer perspective. But also, apart from this 5 lakh cap, we are moving, pushing or, targeting that more and more people move towards new tax regime, which means all your ATC deductions, etc., will not be available to the taxpayer. And in ATC, people used to buy insurance, to save tax. Now, if there is no kind of requirement, it will definitely have some impact on insurance business. So that is also seen, and India is really underpenetrated on insurance. There was some need for from the government side or regulator side that we should push more and more insurance benefit to the people. But I think that is also moving away that kind of a benefit from the people, right? And they will not be, I will say, not looking at insurance as one of the product on which they can save tax.
Sure, sure. Sunil, some thoughts from you beyond some of the products that we've discussed where there is adverse tax impact. What really, I mean, if you were to sum it up for the BFSI space, then what does Budget 2023 have in store?
I will say a big positive for IFSC, which we have already discussed, largely positive for NBFCs. Of course, we could not discuss some of the things that have happened, negative for insurance. But I think what really stood out for me is, financial services been identified as one of the 7 priorities of the government. So I think it's just the beginning, and we are going to see a lot more activities in the coming year.
Okay, you mentioned NBFC, so let me try and squeeze in that question there. What specifically changes for NBFCs from a tax standpoint, and what would be the impact?
Okay, so if especially the foreign-owned NBFCs, they would generally rely upon overseas borrowings from the shareholders or the related parties, and whenever they paid interest, there was a limit of deduction that they could claim on account of interest payment, which was 30% of their earnings. Now that caused a lot of problems for NBFCs to actually borrow funds from their foreign shareholders or the related parties overseas. That a limitation has been now done away with for a specified class of NBFCs, and we suspect that it will be all systemically important NBFCs which will get classified there. So essentially, what it means for the NBFCs is that they can actually now access the borrowings from their shareholders or associated parties.
Okay, so that's good news. Then it's always good to end on good news, right? Which is what brings me back to IFSC as well. Dipesh, so let's end with sort of more forward-looking vision questions, right? With the changes that you outlined, that you spoke of, do you really see the IFSC taking off in a big way? I know we're all waiting for the bullet train to leave BKC in Bombay and reach GIFT City quickly. But, on a more serious note, what lies ahead, let's say over the next 2 to 3 years?
Very well said, Surbi. I think we really see this as a transformation in terms of how the International Financial Services Center is going to roll out. We already have seen tremendous traction with more than 400 firms already in the IFFC zone. But with this new announcements coming in, we clearly see that that's a roadmap being laid down. And in next 5 years, if you really ask me, I would really definitely put my neck out and say that this is going to be a transformation of the International Financial Services Center from a global business perspective. And you will see a lot of institutions, not only from India, but from global centers coming into the IFFC zone to structure the international financial services business and scale up to a level that really the IFFC in India will make its presence felt in the global financial world.
Okay, well, that's an optimistic note to wind up this conversation on. Gentlemen, thank you very much for joining in and helping us decode the budget and go through the fine print and understand what really this budget has meant for the BFSI sector. Thank you very much for watching.
KPMG and CNBC-TV18 present Budget 2023, the fine print.